Hello and welcome everybody to this latest weekly market recap for the week ending May 9th, 2025. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and it's a pleasure to join all of you again this weekend. Kind of an up and down week in the market. We saw, market trying to stage more rallies and then kind of get rebuffed by the bears and pull back a little and then try again. And that was pretty much how the week went. We did have a big Fed meeting on Tuesday and Wednesday. Of course, they left rates unchanged on Wednesday at 2 o'clock when they came out with their policy statement. And most of the policy statement was the same as the prior meeting, but they did say that the risks of higher unemployment and the risks of higher inflation had both increased. And they essentially said they didn't know what to do. They're waiting to decide what they want to do. So it's always really reassuring when you've got the Fed who controls, the money flow and, whether or not, they're going to try to help the economy or whether they're going to fight inflation. It's always reassuring when they tell you they don't really know what they're going to do. And the market doesn't like that kind of uncertainty. So I'm not surprised we had a flat week. We've had a really nice recovery over the past 5 weeks or so off of the April 7th low. And so I think it was time for the market to pause a little bit. And that's what we did last week. I'm still seeing a lot of bullish signs. I'll go over some of those with you in the show today. So I'm still very bullish going forward. I believe that there's a chance we pull back just because we're up against some key resistance or we're rapidly approaching some key resistance. Again, we'll take a look at some charts and I'll show you that. But other than that, what I'm seeing underneath the surface of the market is Wall Street accumulation. And that tells me that in time, stock market's going higher. Even if we do have a short-term move back down to the downside, I'd be buying into it. I'd be using it as opportunity to get in cheaper because I do think by the end of this year, early next year, we'll be at all-time highs again. And so any weakness here in the short term over the next couple of weeks to a couple of months, I think is going to be an opportunity for folks to jump back in if they're still sitting on the sidelines. Got some things to go over though today. Got a lot of information. So let's go ahead and take a look at what happened in the market last week. So starting with the S&P 400 mid cap, you can see gaining 0.5%. You go down to the bottom, the S&P 500 dropped about 0.5%, and everything else was in between. So there really wasn't a whole lot of movement in terms of the action for the overall week. And that's noteworthy because we have had an extremely volatile period since about the middle part of February, where we had a huge drop to the downside, little back and forth action, then a big rally, and now just kind of settling back down a little bit. Volatility index continuing to drop. That's one chart we'll take a look at in just a little bit. I did want to point out also sectors. So we had industrials leading, gaining a little over 1% last week. Healthcare has really been taking a big hit of late. We've actually lost some key support on the long-term chart. I think healthcare had some pretty good support around 135, and we had a rough Friday, ended up closing down at 132.68. So we have lost some key support on healthcare, so we're going to need to have a quick recovery there. Otherwise, that group will be in a position to continue to move lower. In between, though, you can see, again, not a whole lot of action for the entire week. We had utilities, energy. I guess it's noteworthy that consumer discretionary and technology both were green last week, leading the S&P 500. Remember, the S&P 500 was down almost 0.5%. Consumer discretionary up 0.5%. Technology right behind. So those two key areas of the market actually held the market up somewhat, and areas like healthcare were kind of dragging it down. As we take a look at the S&P 500, I pointed out a couple key levels because as we move up and I talk about maybe we top and maybe we move back down a little bit, I'm just a little nervous as we get close to key resistance. I would continue to watch the rising 20-day moving average. You can see that coming up here underneath. Can kind of zero in here for you. But right there, you see this moving up. The last time we went down, tested it, it held. Then we bounced right back off of it, which was very bullish action. But we are trying to get through this area 5,700. And then if we do, we got the big one at 5,782. That was the gap support level back after the election. Right after President Trump won the election, we gapped up from 5782, about 100 points, or maybe 80, 90 points, something like that on the S&P 500. And it took us a couple months before we went back and actually filled that gap. We opened on January 13th at 5782. So again, that same exact number, 5782, comes up twice. Then we rally. The final rally is in February, and then we break down below 5782. And look where we came back up to before we failed. We got through the 20-day moving average. So if you're using that moving average, you think, oh, everything's peachy again. Well, except that we weren't able to get back through 5782. I think we traded intraday at 5786 or so. Could not close above 5782. Went back down, tested that recent low in March, and then we've just completely fell apart beginning of April. Volatility shot up to 55, 60, and market was under a lot of pressure, intense, impulsive selling. Went down, set that low, and now we've worked our way all the way back up, and we're getting close to 57.82 again. So I just know that that has been a big level. I think we're going through it. I don't know if we'll go through it the first time, but I believe we're going to go back through it and go back and test the February high, ultimately breaking back out again. But in the meantime, I think in the short term, watch 57.82 to the top side, and then watch the rising 20-day moving average, which is just about getting ready to cross the 50-day moving average. It is right now 5 points below it. So probably the first or second day this week, we'll probably be back up above, get that golden cross, unless the market really falls apart. But I would, at this point, I think things are settling back down again. I think we're starting to get rid of some of those uncertainties. We had the framework of a trade agreement between the United States and United Kingdom last week. I think that helped steady the market a little bit. And I know there's some ongoing trade negotiations with China over the weekend. Depending on how that goes and how it's perceived early this week, that could be what drives the market early on. But I would, again, watch the levels that I've talked about here. Volatility index. I mean, once we got up to that 55, 60 level, you can see we just keep coming down. And this is the history of the market. Volatility index, the VIX, does not trend. It spikes, and then it works its way back down. Then it'll spike, then it'll work its way back down. So using moving averages and things like that, or price support, to me, don't make a whole lot of sense on the VIX, because it's not a trend following kind of a price. It doesn't follow trend. It just goes up, back down. I mean, look at back in early August. We had the S&P 500 sell off early August. We had this huge spike in the VIX, and then right back down. And that huge spike in the VIX marked the bottom. Go back to December, huge spike in the VIX. We went down, we ended up going just slightly lower, but for the most part, that low held, and we went back to new all-time highs. So when you get these big moves, a lot of times it is, especially when you get up in the 50s and 60s. I mean, this is rare territory for the VIX. So when you get up to these levels, usually it coincides with an extremely panicked sell-off, which is exactly what we had at the beginning of April. We started losing 5% a day for 2 or 3 days. And that's what ultimately marked the low. I think we hit that point of capitulation. The VIX started coming down, prices started recovering, and now it feels like it's a little bit more normal market than it was there for probably about 3-4 weeks. Keep moving on. US dollar. So I've been watching the dollar because, of course, gold has been probably, if not the best performer in 2025. It's certainly been one of the best. So the price of gold, gold miners, and so forth. The two things that really drive gold, if you go back and look over history, the two things that drive gold to the upside, to outperformance above the S&P 500, that's the only time I'm interested in gold. If gold is underperforming the S&P 500, it can go higher. I don't care. And I think it's set to go higher. The question is it going to outperform the S&P 500? Because if it doesn't, then if you own it, it drags your portfolio down. Now, during this period of a falling dollar and a rising volatility index, that historically has been when gold tends to outperform the S&P 500. So when you've got a weak dollar and you've got increasing fear, increasing volatility, that's normally the time that you want to have that hedge in place with gold. Once it ends, you no longer want that. So I got a couple charts I want to show you here. One, here's the dollar coming down since the beginning of the year. So it was about, I think that was actually January 13th. So January 13th has come up a few times. Remember, that was where the S&P 500 went down and hit that 5782 level and then bounced. That was on January 13th, the same day that the dollar printed its high. Anyway, since then, dollar's been coming down. And look at this is the CRB index relative to the S&P 500. So this is a lot of different commodities, not just gold. In fact, I think I don't know the exact weighting, but I think energy is a big component there. So energy prices were going up when the dollar was coming down, but the crude oil price has really slumped over the last several weeks. And as a result, we've had the CRB index as a whole has been coming down relative to the S&P 500. If you look at gold relative to the S&P 500, we've got it down here. When the dollar topped and we started dropping, almost immediately, that's when gold started outperforming. And then when we bottomed here in the dollar and started recovering, you can see that's almost exactly when gold peaked relative to the S&P 500 and began underperforming the S&P. Now, the reason I bring this up is if we pull up a chart on the dollar, let's go back. This is 20 years. And I'm going to annotate this. But you can see along this line right here, if we connect those lows, you can see right around this 97, 98 area is just about where we connect this trend line. And we can probably drag it, probably see a little bit of the same thing up here. Yeah, I mean, we got kind of a little bit of a channel going on. So the highs follow this same slope as the lows. So this is a pretty important, I mean, this is a 15, 16-year channel that we're testing the bottom of the channel. So I was calling for the dollar to bounce back up off of $98, and that's what we've done so far. Now, if the dollar breaks back down and moves back down below 97, 98, in my opinion, that's when you probably want to keep at least some of that gold in place. Because again, if the dollar's breaking down, it's probably a signal that our economy is weakening further, and which would probably lead us maybe to the market rolling back over again. Again, I know that there's a lot of accumulation that's taken place, but we don't know for sure that the market doesn't roll over one more time. I thought we had bottomed back in 2022 in the middle of the year, and we ended up rolling over one more time in October. So it's possible. I just don't think there's a whole lot more downside, not from where we were. Now, yeah, from where we are now after the big rebound, sure. I mean, we could move back into that range a little bit. Down to the 20-day moving average would probably be 2 or 3%. And then we'll kind of go from there, see if that holds. Another look at gold. Here's gold on an absolute basis. So it's definitely trending higher. And I don't have any problem with gold. I think gold could continue to trend higher. But if I'm right about the market reversing and continuing to strengthen, I think we see the VIX go down. I think we see the dollar continue to rise. And I think both of those combined will lead to underperformance in gold relative to the S&P. So here you can see we tried to make another breakout on the absolute price chart of gold, but on the relative price chart versus the S&P, we never came close. We gave back quite a bit of 2025 relative gains in just about probably about a 2-week period. So we got to continue to watch gold along with the dollar and the volatility index. So one more chart. Here's a long-term chart of the S&P 500. Now, I want you to look at gold relative to the S&P 500. I mean, everybody's talked up gold like it's the best thing since sliced bread, and it has been in 2025. But look at the long-term relative strength chart of gold versus the S&P 500. 2011 through, we didn't bottom until about 2021, end of 2021. But we've had spikes, and these spikes have occurred usually with that higher volatility, which could be associated with rising interest rates, with rising inflation, anything to drive fear in the market, tariffs. Those things have been what's been driving some of the fear in the market, sending volatility to the upside, dollar to the downside. And that's what gets these spikes in gold that we see from time to time. This isn't the first time we've spiked in gold. We had one back at the beginning of 2020 with the pandemic. Everyone was panicked and thought that was going to be the best thing ever. Jump into gold. Well, gold underperformed the next 4 years after that. So you want to be careful. Watch the dollar, watch volatility index. They're going to give you two big clues as to whether or not you want to own gold or whether you'd rather be in stocks, namely the S&P 500. All right, I want to go over this relative rotation graph because I did a show on the stock charts YouTube channel last week, middle of the week, Wednesday, Thursday, and I talked about 12 industry groups that were really showing a lot of strength. So I want to talk a little bit about that using the RRG chart because this is such a wonderful visual tool. My good friend Julius de Kempenaar, he's the founder of the RRG charts, and I mean the work here that he did was brilliant. I usually, maybe I don't know, maybe being in public accounting for so many years, I kind of like using numbers and percentages and charts and relative charts and things like that. But if that's not your cup of tea, I mean, this really shows you visually what's going on in the market. So the center point here is whatever you choose to be your benchmark that you're comparing things against on the RRG. So as you are improving, you'll see a line come up and then you'll start leading your benchmark and then you'll start weakening against your benchmark and then you'll start lagging. So it's always this, anytime you get this, whatever you're looking at relative to a benchmark, when it's moving in northeasterly fashion, when it's coming up and moving higher and to the right, that's what you want to see. That's where you're seeing strength. Now, I'm doing this as of a year ago, and I wanted to show you semiconductors first and just show you how this works. The benchmark for me, I've got the S&P 500 in right over here. You can put in whatever benchmark you want. If you're comparing a symbol to another symbol, comparing a symbol to an index to an index, whatever it is you want to compare. Here, I'm looking at the Dow Jones US Semiconductor Index, and I'm following it. I want to show you how you can follow its relative performance versus the S&P 500. So this is just going across time. You can kind of see here in 5 trading days ending June 4th. And as I drag this across, there's June 10th, 11th, the 26th. There's July 9th. There's the 30th. I'm just, looking at these dates up here. So when I go back from 1 year ago, I want you to just follow the rotation of the semiconductors. I mean, they outperform for a period of time, then they underperform, they come rallying back, and then they go back down, and then they come back up, then back down. And then for the last bit until just recently, we were kind of remaining over on the left side, which the left side is, this is the, if you're looking horizontally, this is the relative strength. So when you're on the left side, you've got poor relative strength. When you're on the right side, you've got good relative strength. The vertical axis here is the momentum. So if you're on the upper half, you got good momentum. If you're on the bottom half, you got poor momentum. So if you're above this line, this horizontal line, it means you got good momentum. And if you're to the right of the horizontal line, right, or the vertical line, that means you've got great relative strength. So when you're over here in this leading quadrant, you've got relative strength and momentum. So this is when this is the time you want to be invested in an area or in a stock, is when it is got great momentum and great relative strength. So anyway, check out, this is on a daily RRG, by the way. So these are moving pretty quick. I'll show you a weekly in a minute. But when we got to the bottom on April 8th, there's the 7th. Look at what semiconductors were doing. Semiconductors were horrendous. They were being thrown out, the baby with the bathwater. Well, they were the baby. They were being thrown out with the bathwater. Nobody wanted to touch semiconductors. But since then, there's the momentum coming in. We pulled back one more time. And then here recently, look at the explosion in semiconductors. So we're starting to see that. Now, again, this is on a daily chart. Weekly wouldn't be moving quite that fast. It takes a little bit longer to get the weekly RRGs moving like this. But I can go back down here. Hold on, let me go back down and I'll get rid of that. So now we can see there are 12 groups that I have on this list: heavy construction, electrical components, electronic equipment, software, travel and tourism, semiconductors, aerospace, investment services, full line insurance, specialty retailers, specialized consumer services, consumer finance. All of these are on the right side of the chart here. When I pull this up, every one of these groups is on the right side, meaning that they are leading the S&P 500 right now. These are clearly areas of the market that you want to be considering if you're trading. Now, I can go back up and we can start, I'm not going to go all the way back to the beginning of the year, but as we were making the final high, this was going into February. This is late January. Look at semiconductors down here at the bottom. So this is the all-time high, January 27th. And then we go into February, we have another all-time high later, right? Look at where we are here when we hit this high. So we're near the high here. Look at semiconductors, absolutely falling apart. Heavy construction, electrical components, travel and tourism. Almost a lot of these groups were making their way over as we were finishing that all-time high. And then we started selling off. So a lot of groups were not performing well. You can see full line insurance was one of the outliers, continued to perform extremely well. Aerospace, you can see here, trying to turn back up in the leading quadrant. But for the most part, these groups were over on the left-hand side. And then they started to strengthen as we were going down. We made one final plunge into early April right there. And then since then, look at all of these groups coming back. These are your leaders. And you can see that, I think, pretty clearly on this visual. Now, we could go to a weekly chart and save the changes. And so then now we're going to go back to the beginning of the year. Now you see it, things move a little slower now on the weekly. But here was the bottom in April. And now this is what it's starting to look like. Look at all of these starting to turn back to the upside longer term. So they were kind of underwater for a while, but now they're all starting to turn back up. Even semiconductors. It's the furthest one over to the left. So it's the weakest in terms of relative strength right now on a longer term basis, but it's starting to come up. And what I can tell you about semiconductors is when they get moving, you want to move with them. All right. Now, I said earlier, I'm really bullish about what's been going on in the market. This is a chart. I want you to focus on the top two panels. The bottom panel is the S&P 500, where we've broken down. The middle panel is the XLY versus the XLP, discretionary versus staples, but it includes gaps. So to the extent that we were having gap downs and the XLY was taking big hits to the downside, many of the aggressive groups were. But that really played a big role in the fact that the XLY XLP ratio was going down, and it's come back up, but it's nowhere near where it was back in mid-March. Still got plenty of room to get back to where it was in mid-March. That was if we include gaps. What if we ignore gaps? Because I think gaps are the way market makers manipulate all of us. When you're losing money and you see the market down another 4% at the open, and you're like, I can't take this anymore. A lot of folks sell in the morning. And so it's the buying that comes in the afternoon you have to watch to really get a sense for what's going on in the morning or for what's going on in the market. So here, this is the same chart, but it's intraday only. It ignores gaps. It's not swayed at all by that manipulation at the opening bell. And with all the headlines out there, the nasty headlines, of course, bad news sells. We know that. And so folks see all that bad news and they start thinking it, they start believing it. I believe that individual retail traders get brainwashed by the media and don't really look, don't look at the market using perspective, using some common sense. And so what I did is I developed an intraday ratio between the discretionary and the staples, ignoring the gaps, just to see what's going on during the trading day when market makers are actually buying and or selling for their institutional clients. Look at this Look at what's going on between discretionary and staples. Aggressive, think aggressive versus defensive. The aggressive group, the discretionary group, completely crushing staples since the middle part of March. Money, in my opinion, has been rotating into discretionary. I think Wall Street, while we're getting all these bad headlines, we're getting these gap downs, everybody's panicking out. At least that's what happened a lot in April, late March, early April. Now we've got folks, Wall Street in particular, jumping in. So anytime we go down in the morning, they're more than happy to buy rest of the day. And that's how it's showing up. Now, if you think, well, this, so what? When has it worked before? Well, worked pretty well middle part of 2022. You see the S&P 500 down here on the bottom did go back down to one more low, but look at what happened with the XLY, XLP that included the gaps. It went back down in this May, June period of 2022, went back down to the prior low, and later in the year went to a new low. Look what happened on an intraday basis. See what was going on? We were going straight up while we were struggling here. Look at this, going straight up while we're struggling in here. Money is rotating. Wall Street is buying. So you can believe the market's going down all you want. I believe the market's going back up. And Wall Street's not getting into these stocks because we're going to have this long drawn out secular bear market. They would have never been buying these stocks and getting back into them. So that's my take from charts like this. I think that there's accumulation taking place. I think there's a lot of really, really strong stocks out there, some strengthening and some are going to get a whole lot stronger. So I wanted to go through real quick and go over some charts that I think, well, these are stocks that have done very well over the course of the last week or so. And about half of them I trust and half of them I don't. So let's go over the ones that are here and which ones I trust and which ones I don't. Trade Desk. Trade Desk, you can see, first of all, the AD line is almost at a 52-week low, even though it's really started to come off the bottom. I'm not sure that this one's quite ready. I think it's probably going to take some more time to consolidate. It was a great week last week. That's awesome because anybody holding the stock for the last 5 months has been tortured. So it's good to see it coming back. I don't know that this is necessarily the start of a bigger move just yet. I think you might have an opportunity to get in a little cheaper at this point, maybe back down to the 20-day moving average. Next up is Insulet Corp. This is POD. This is one I love. Look at the AD line here, setting new highs. Look at this breakout with earnings and a hollow candle, which means to me there was just demand all day long. There's not even a tail coming out of the bottom there showing any weakness whatsoever. The stock gapped up, and a lot of times market makers will be on the other side of those trades shorting, and you'll see the stock pull back intraday, at least for a while, and a lot of times to fill the gap. Here we got none of that. There was buying at the opening bell and continued buying all day long. I love this chart, PODD. Next up is Charles River Labs. AD line, had a nice little move there, but it started rolling over. Most of the move to the upside here with earnings was with a gap, not really any follow through. So I'm a little suspicious on this one. Then we've got Rockwell Automation. AD line's awesome. Look at the three moves. They just continue buying even after the gaps. We're getting close to a 52-week high. We might struggle at that level, but I do like Rockwell. I think this is one that goes higher down the road. Then we're going to go to Microchip in the semiconductor space. I like what it's doing here, but I like some of the other semiconductors better. AD line looks like it might be starting to roll over. Relative strength versus the semiconductor group just in the last few weeks had a new 52-week low. I'm not ready. I'm not sold on this one, but I do think some of the semiconductor stocks are starting to roll. When I updated our raised guidance chart list last week, there were a number of semiconductors on it. So I know everybody's talking about the trade war with China, and that's normally impacts a lot of those semiconductors, but many of those companies are raising guidance. So you can believe the media and what they're talking about, or you can believe the charts, and I'm going to stick with the charts every time. All right, let's go on to Disney. I like what's going on with Disney here. AD line really didn't go down much, even though price was getting killed back beginning of the year, first 3 or 4 months of the year. And now that we're starting to turn back up, AD lines just moved to about a 4-month high. relative strengths picking up, volume trends look good. I think Disney looks pretty good here going forward. Gen Digital, one of my favorites coming out of earnings. This completely turned everything around in earnings. AD line was already pretty good, but this was a very, very solid move, taking out some overhead resistance, taking out gap resistance, just a lot of good things on this chart technically. This was one that just a few weeks ago was, not looking very good on a relative basis. I think this information that came out with earnings is critical. I think this stock has turned a corner. Any kind of a pullback down near 27, I would really like GEN. Celanese CE, still in the downtrend. I mean, things are getting better, but we haven't gotten back up above where we started selling off from in the beginning of April. Volume trends are just okay. Look at the relative strength, still pretty poor. I'm going to put that in the not so great category. ENPH. Now, this is one that I'm going to keep in the not so great category, but I'll tell you what. I saw First Solar getting a lift last week, and some of these others, Solar Edge Technologies, SEDG, had a huge move last week. When these stocks move, they move incredibly fast. And ENPH, for the first time in about 6 weeks, was able to get back up above its 20-day moving average. Volume came in, stronger. It's got work to do. I'm going to put it in the not so great category, but I wouldn't throw it away. I wouldn't, stop watching it. This is one that potentially, if it catches fire, this stock could run to 100 and double from even its current price pretty quickly. If you go back and look at history, these renewable energy stocks can really move. PAYC, this is Paycom Software. I like this one. I think this one's kind of up there with, what was the one I had up there first? POD, PODD, the early one. So I think Paycom Software is kind of like POD. We got that breakout with earnings. AD line looks great. Relative strengths off the chart. Volume trends are awesome. I think this one goes higher. Anything back down around 240, 245 looks like pretty good buy to me on Paycom. All right. For those of you that are new to Earnings Beats, first, welcome. We certainly appreciate you joining in and finding us. If you like what you see here today, hit that like button and subscribe to our channel. That will help us as we try to build our community here on YouTube. Of course, those of you who've been following us for a long time, we certainly appreciate your support. That's what keeps us going. Members especially. Those of you who want to start a no-cost 30-day trial, got right there. That green button right there will do it. You do have to give a credit card, but we will remind you before you get charged, and we'll give you a great annual offer as well to save you some money. But when your 30-day trial is up, we will reach out to you. We're not going to just, have your credit card get zapped or whatever. We want to make sure you want to be a member. So check that out. If you just want to learn more about us, we have a free newsletter. No credit card required. And scroll down and subscribe to our Earnings Beats Digest newsletter. Comes out Mondays and Wednesdays, twice a week. Name and an email address, all it takes there. You can unsubscribe at any time. Love to have you. A couple of things on that. You'll see this Bowley Trend market history. This is a 100% free PDF. I've done a lot of analysis of the S&P 500 over the last 75 years, and I have some trends in here that if you don't know them, you're going to be absolutely blown away, and it's going to change the way you trade the market. So make sure you click on that. That will bring up this page right here. One of the things I talk about is why go away in May is a myth. Stop following it. Last 5 years, May's been really, really good. And there are parts of May and June and July that are extremely strong. There's the real go away period is later in the year. And I go over all that much, much more. But this is a free download. So go to our website. You'll see it right in the middle, right here, Bowley Trend Market History. Click on that for a free report. You won't regret it. All right, I'm going to finish with a few charts. I think you're going to know most of these companies. Netflix. So it was about, I don't know, it was probably about 3-4 weeks ago. I was talking to our members. I did a manipulation spreadsheet so I could show how the NASDAQ 100, how the S&P 500, how the Russell 2000 have all been manipulated. I think what I pointed out is pretty clear. You can debate it if you want, but the numbers are there, that it's factual. I think we've all been manipulated. I think that's what happens whenever the market goes down. I think there are ways to spot tops and bottoms. I don't think anybody's done it any better than we have over the years. And so I started looking at individual stocks using the same criteria. And the stock that I talked about 3 or 4 weeks ago, and I said the one that was most heavily manipulated and the one that is being strongly accumulated, like crazy accumulated, was Netflix. That was a few weeks ago. I want you to look what this stock has done now since. Broke out above broke this pattern of lower lows, lower highs. And since then, the stock's tacked on 15% in 2 or 3 weeks. The next one that I see, and you can see the AD line's awesome. The next one I see coming is Tesla. AD line's awesome, was getting beaten up. This is another one where we've seen a lot of opening gaps to the downside, a lot of morning weakness, followed by a lot of accumulation during the day. Friday, we saw the volume pick up. We got a breakout above these highs, these previous tops. We bounced off the 20-day. These are all signs of an uptrend. I think Tesla is poised to make a big run to the upside. And I think that's what the manipulation spreadsheet's been telling me. By the way, if you're an annual member at Earnings Beats, go check out that trial, because if you like the service and you become an annual member, you'll get that spreadsheet. We don't give it to everyone because it takes a lot of time to do. So we do a lot of, we make a big commitment for our members in terms of research and guidance and education. And that's all we ask for in return. If you become an annual member and you show us that commitment, we've got charts, or we've got spreadsheets like that manipulation spreadsheet, proprietary research that we pass on to our members. Makes a big difference in your trading and in your financial future. Next up, NVIDIA. I just want to mention NVIDIA is going to be reporting earnings in a couple of weeks. Their AD line is strong. They too are starting to trend above the 20-day. This stock has a history. And if you don't believe me, take a look at this chart. This is a seasonality chart. NVIDIA has a history of running up into its earnings. We got 2 weeks to go before its earnings. Here, look at the months when NVIDIA does the best. February, May, August, and November. These 4 months are when they report their earnings. I think it's pretty obvious that NVIDIA does very well heading into its earnings. So, and this is over the last 20 years. This isn't like this is what's happened the last 4 quarters. This is over the last 20 years. These are the average times that NVIDIA has gone higher in these months. By far, February, May, August, November. Those are easily the 4 best months. And if you look at returns, average returns, which are down here on the bottom, if I add up all the first months of the quarter, January, April, July, and October, I got that over here somewhere, NVIDIA averages going up about 8.8% during the first months of each calendar quarter. The earnings months, which are the second, if you add these numbers coming across, you will get 27.3%. That's the average return every year for 20 years. That's the average return over the last 20 years if all you did is owned NVIDIA during these 4 months of the year. So you only own it 1/3 of the year, 4 months out of 12, but you own it during the earnings months, and you would have gained an average of 27.3% a year. Now, these other months aren't bad either. I mean, just own NVIDIA. It's been a great company. Month 3, so we're talking about March, June, September, and December, it averages per year going up 6.3%. So month 1, 8.8, month 2, 27.3, and month 3, 6.3. So NVIDIA has been a great stock to own, but especially in the second month of the calendar quarters, especially in its earnings months. And now we're starting to see technical signs. We're breaking out above moving averages. We just got the golden cross. The AD line strong. We're starting to see a little bit of relative strength here. I mean, this is one if we go back, and we could go back a long time. Let's go back 20 years. Whoops, that's not what I want to do. Let's do it this way. Let's go back weekly. Let's go back weekly for 15 years. And you will see look at the relative strength. I mean, it's just been consistently off the charts, as has been the AD line. I mean, this has just been a great stock over time. but especially during the month of earnings. All right, that's all I got for you today. We got a big week coming up. We got the inflation numbers coming up this week. That's going to be big. According to the Fed, they don't know what to do. Hopefully, the inflation reports will kind of set them straight, because they obviously have not been watching the inflation reports for the last couple of years, because inflation just keeps coming down, down, down. And yet they're still worried about the ghost of inflation. We'll see if this upcoming report this week, we're going to get the core inflation. I think that core CPI data comes out on Tuesday and the PPI data comes out on Thursday. I looked at it a while ago, so I'm kind of guessing. But I do think the CPI comes out first. And I think it's Tuesday, Thursday, but double check me on that. But those are going to be the two wild cards for this week. I mean, if inflation does pop up, then you're going to see it all over media. And we're probably going to go back and test those 20-day moving averages. If those numbers come in light again, I think we could go right through that 5782 level on the S&P 500. We'll see together. Anyhow, have a good week this week, and I'll be back next weekend to do it all again. Happy trading, everyone.